Hello, everyone. It's great to be here, and what an act that we have to follow. I obviously wore the wrong jacket today, but hopefully you'll forgive me. I'm Carolyn Abramo. I'm the CEO and founder of Panal, Low Carbon Economy Investments, based here in New York City. I'm so thrilled that we get to have this event in New York City, and I really thank the whole SALT team for giving us this opportunity to talk about what we think is the best investment opportunity of our lifetimes, besides Bitcoin, of course. And so I would love to bring you in and meet the panel. We're going to talk about a lot of what I call macro ideas about the space. PANA, our firm, is dedicated to what we call growth equity. So we're really bridging some of the breakthrough technologies that have been developed to reduce carbon in all our major supply chains, so all of our real asset supply chains, getting them to the stage where they could be deployed into large-scale infrastructure. And that's really the topic, is really infrastructure. And my esteemed colleagues will talk about how, from their perspective as both asset managers and investors, they're actually doing that. They're actually making investing decisions and really bridging sometimes what the gaps are between the way government supports some of these technologies and these infrastructure investments, the role of corporations, and the private sector. So we'll talk a lot about all of those. And so without further ado, I want to introduce my panel. So each of them is going to tell you a little bit about their role and something fun about them. So Petya, if you can start.
Thank you, Caroline. It's a pleasure to be here. Good afternoon. I'm Petya Nikolova, and I lead the infrastructure asset class with New York City Retirement Systems. New York City Retirement Systems are the fourth largest pension plan in the US, currently with total AUM over $260 billion. We invest across a variety of private markets, but for the purposes of this panel, the infrastructure would be the most relevant one. Infrastructure we started around 9 years ago, and we continue to invest very actively across different sectors, and as we will discuss later on, a lot is going on in the sustainability space.
Thanks, Petya. Maureen?
Hi, I am Maureen O'Toole, and pleased to be here and not in Las Vegas, I will admit. This is always a great conference. I started attending years ago on the hedge fund side. I spent all of my career in the alternative investment world. 2 years ago, I joined Actis. We are an impact and private capital manager based in London. What I'm excited about is to tell you more about what we do at Actis and to raise the level of awareness around what is achievable, both in terms of getting really good market rates of return and in terms of taking a look at what the leave-behind effect of your investments are on the ground. I was thrilled to get to Actis because I had been hearing about impact investing. We hear all these terms, ESG, sustainable investing, and Actis has a 70-year-plus history in this area because they were originating within a development finance institution in the UK, actually. They started a private capital investment arm within a DFI to show that market rates of return can be made, exits can be made in developing markets. And so I think that will be the angle that I will take today. We did not start as a carbon neutral or a carbon type of an investment arm. We started to bring power to people who don't have power. When we started, there were nearly 2 billion people in the world that didn't have access to electricity. Today, there's approximately 1 billion. Great tailwinds, great supply-demand inefficiency, and a great way to make market returns for our clients.
Great. So, hi, everyone. I'm Pieter Houlleberghs. I'm with Temasek, the Singapore-based investment firm. I'm in the New York office. I lead our energy and environment practice for the Americas. So that includes clean energy, water, waste, really energy transition and circular economy focused thematics, both private and public sector investments. And yeah, I've been with the firm for 8 years, spent 8 years prior to that also in the energy sector, and have been thrilled to be part of a firm that's been transitioning and helping to also help industry transition as we look at decarbonization as a massive investment opportunity, which simply makes sense. And I think, as Maureen had said, I think we're also very much driven by that huge opportunity, and excited to share a little bit more about it today.
So thanks. So it's great. Well, I didn't hear any fun facts, so we're going to get back to that because you're not eluding me. So Petya, just starting with you, just wondering how the firm got comfortable with this specific investment area and the transition to a low carbon economy, and how your investments look versus what was currently in your portfolio, and maybe what's still in your portfolio, and how you're thinking potentially of transitioning all of it to a low carbon economy.
Yeah, absolutely. And I'll start with a little bit of a bigger picture above infrastructure. So what do we do as an organization at the plan level? What we have done is we have divested a few of our boards from fossil fuels, but we also started investing, and that is the more interesting piece. We have tripled our investments in sustainability over the last 3 years, again, at the plan level. For infrastructure specifically, the dynamics has been extremely interesting, and that's to the point that both Maureen and Pieter made, which is that without necessarily focusing from the very beginning on sustainability in the infrastructure portfolio, as we as an investor could invest across a variety of asset classes, more traditional ones like transportation, or the newer ones like digital infrastructure. And yet, we invest primarily through funds. So where the opportunity has been, it has been renewables and sustainability. So our portfolio has very organically grown in renewables, and they represent currently the largest portion of our investments. And if we add other sustainability themes like energy efficiency or battery storage, it would be even larger portion of the pie. And I think the key here, Caroline, to your point about how did you get comfortable, it's based on returns. There are money to be made there. And we go through a very thorough process of due diligence to understand exactly the risk and return profile of these investments. So far, it has been a great opportunity.
Yeah, that's really helpful, Petya, and to know that with solar and wind that we're on a trajectory of, it's been started at 20 years in the making, in terms of achieving the right level on the technologies and de-risking them so that now that they're considered basic infrastructure. Maureen, in terms of Actis and how you've taken advantage of, let's say, the renewable sector, maybe you can talk about, your focus and, and where it is, and we'll go back to you, Petya, in terms of just geographies. Like, being in New York City, are you focused only on, on the U.S. or is it a global mandate? But Maureen, maybe you could talk about your portfolio.
Right. So as I said, we're a power generation company, or the area I'm going to talk about. We do other things. We do digital and data center, but for the sake of today, we'll talk about the power generation. As I said, we didn't start doing renewables because they weren't affordable. So what's so important and I think so exciting for investing right now is we're raising a fund right now. It's done. And this vintage year of ours is going to, I think, be one of the most transformative. When we started our first fund 15 years ago, we were doing thermal. We were studying wind and solar. The minute they got affordable, the minute that their cost per kilowatt hour dipped below that of coal, which is just sort of the base case, we were able to pivot very quickly. What's so exciting today, and we'll touch on it, I hope, is the new work that's being done in the renewables that will propel us for tomorrow. And that's going to be primarily in battery and storage and perhaps hydrogen as storage. What we do right now, as I said, is wind and solar, because the minute that price became affordable, when you have input that costs zero, sun costs zero, wind costs zero, that is the most affordable way for an emerging market to bring power to its people. So today we build large-scale solar and wind plants. We have offices in 17 markets around the world. We invest broadly throughout Latin America, Africa, India, and Southeast Asia. We do nothing in the developed markets because of our history of being part of that DFI that focused primarily on the emerging markets. And in so doing, we keep track of how much carbon are we reducing out of the atmosphere. Many of the places that in fact, does anybody know how much of the world's power is still generated by coal? 30%. Go to a country like India. Almost 90% of electricity in India comes from coal generation. So I go back to when you're an investor, you should be looking where there's that supply-demand imbalance, and how can I take advantage of this huge transition and transformation that is going to occur. Yes, we will have infrastructure investment in the United States, and yes, we will continue to build renewable power. But the biggest opportunity from a global carbon impact and from a life impact is bringing electricity for the first time to people, or bringing industrial electricity so that you can actually have urbanization and improvement of lives, and taking that carbon out of the world's atmosphere, because it is a world measuring problem. I'll give you one more stat. As we measure it, and metrics are important, greenwashing, impact washing, all of those things are very real. So we keep track and we compare. If this hadn't happened, if we hadn't moved from coal to natural gas, what would the carbon emission have been? And we have, since our inception, taken 15.7 million tons of carbon out of the atmosphere. That's just us. We're only a $16 billion firm. So it just shows you the power of what can be done in renewables, where $1 trillion has been invested over the last 10 years in renewables, and the estimate is we need $20 trillion to meet that demand and need, especially in the demographically driven emerging markets over the next few years.
And continuing with that trend, thanks, Maureen. And Pieter, since Temasek is based in Singapore, however, global reach, and to some of Maureen's comments about the amount of carbon that just Actis has been able to reduce over their time in wind and solar, maybe you could talk about some of the other areas that you're looking at, and maybe the entire, let's say, carbon balance that we are trying to reduce. So how much carbon are we really talking about? And maybe, aligning with a lot of folks have heard, about the Paris Accord goals of 2050, and aligning with those goals, which are the subsequent result would be to not raise surface temperatures by 1.5 degrees. So we'll get into that later, but Pieter, maybe talk about some of the areas of focus.
No, that's hugely in focus for us. I think I would start by saying, though, as well, that the cheap, clean power is certainly the fundamental building block, which everything else has to stem from. But as we look beyond that, we look at really industry, transportation, and materials as kind of the main other areas where I spend my time. And in industry, it's really the non-electric emissions, so heat or process emissions, that do present a fairly low-hanging fruit opportunity as well to decarbonize, and also increasingly an economic one. I think you've got a sort of trifecta of policy, as well as the actual technologies are starting to mature to a point where they make sense and they've been de-risked, and as well as then the fundamental building block that I started with, which is the clean power. So I think those three together are unleashing business models that are ready to scale, and in many cases, in our view, the challenge is largely a business model and execution challenge. So really pursuing that and supporting the management teams that are looking to seize that opportunity is what we feel passionate about, and also working together with other investors and really kind of trying to get to the right answer, which is, as Caroline mentioned, sort of the overall climate objective that is at this point relatively well known and understood, but is extremely challenging to achieve. So we'll take concerted effort and a coordinated effort to be successful around. So the industrial piece is an area that I spend a lot of time. Transportation and materials are also hugely of interest. I think the risk profiles change in each of these areas. Materials is a space where I think it's intriguing that there's much less need for policy than we're seeing in perhaps the energy or industrial decarbonization space. There's huge pull from corporates that are willing to co-develop with technology companies and really provide that line of sight to fairly long-dated offtake at scale for some of these facilities that get built out, which then gives investors the comfort to underwrite and really get these breakthrough technologies off the ground.
Yeah, thank you for bringing that up. So in terms of like in light of not having incentives, so because a lot of people will get nervous about this space by saying, well, if there are government incentives like we started with wind and solar, I'm not comfortable with that. The governments could change those. That's not an investment risk that I'm willing to take. However, when we look at some of these other areas that we're looking to decarbonize, which are the kind of the big ones that are the most carbon emitting, we see that companies that have good operating margins, and that they can exist incentive-free. So they can have 20, 30, 40%, 50% operating margins outside of an incentive scheme. So, and that's, I think, what Pieter is referring to. And maybe I'll get him he can talk a little bit more specifically about, a few of those, or at least one of those examples, like some of the industries that we're trying to decarbonize, like cement, steel, glass manufacturing. These are the big areas where there is big carbon emissions. So I don't know if you can speak a little bit more about maybe a technology or a group that you've seen and how that's playing out.
No, that question sort of touches on an aspect that I think is important to highlight in this panel, which is really it's a stock and flow example, right? So we have this huge capital stock that's out there and is really, in order to move the needle quickly enough, I think looking at the flow of new solar and new EVs and all that is hugely important and will be an attractive investment opportunity. I think there's a second piece, which is really looking at the existing stock and finding the technologies that can be retrofitted or cleverly integrated into those whether it's factories or other types of infrastructure, really smartening things up, doing carbon capture. So I think what Caroline was encouraging me to speak about is the carbon capture piece, which is clearly can be done directly from air or from point source at industrial sources of emission, which is the latter part is an area that I spent quite a lot of time on, and I'm excited to really be digging into that space because it's very multifaceted. I think capturing the carbon is one part of it. So going up to being able to offer a cement company or a industrial gases business that's got a hydrogen manufacturing facility, offering them as a service the ability to, without messing with the process that's there, the industrial process that's clearly very delicate, to retrofit onto that carbon capture technology that is in and of itself a viable economic proposition for the investors putting up the capital. We are very close to that really breaking through, and I think we're working hard to really make that into a reality, because I think at that point you'll unleash a ton of capital that's ready to be deployed into that space.
Yeah, and I guess just to scale things, when we talk about early days solar and wind being really expensive, Maureen's talking about and how we've de-risked it. Similarly with this carbon capture technology, most of it from like direct air capture, which literally is taking carbon out of the air, we're talking about $200, $250 a ton that would make that economic. However, one of the opportunities that Pieter's working on, I'm working on too, in the terms of point source capture, it can actually be feasible and profitable at $50 or $70 a ton. And that's actually directly relates to, in the US, some of the legislation that's underway. Not just under Biden, but in terms of what's been happening with some tax credits, with the 45Q tax credit, which currently gives $50 a ton credit to people that develop some of this technology. So just for an example and a level setting, and in terms of how these things are becoming very economic and profitable. So so there's definitely now a de-risking piece that's happening. Petya, how would it be, so for you and the plan, how would it be to start thinking about some of these new technologies? Like kind of what's the process, how do you, like when you put them all against each other in terms of like risk return, like how will you start to think about some of these newer areas?
Yeah, it's an interesting question because on the infrastructure side, we like a lot of the technology risk being taken out of the deals. The role of infrastructure in our portfolio is capital preservation, stable and predictable cash flow. So, you know, it's an interesting balance, and at the end of the day, it's a question of how it is de-risked. So if there is another party that takes this risk that possibly makes the deal more appealing from our perspective on infrastructure. We also collaborate with our private equity team so that we understand the themes and growth equity. We don't do venture, but we collaborate with them just to get an understanding of how the space looks like today and where it's going tomorrow, what the impacts might be on our infrastructure deals going forward. So that's how we're thinking about it. It's not a very well-defined process. It's just something that we try to look through and think about as we see new technologies emerging.
Yeah, I think another part of that, and that's great that you mentioned just in terms of that de-risking piece of the kind of in these opportunities, the offtake agreements. So when you have, when power, if you can sell your power forward for 20 years, 30 years, it becomes a stability of cash flows, which, you know, for then an investment makes it much more palatable where, and if government's not there, then who's going to step into that? And what we've seen, and I think the whole panel's seen, corporations are stepping into that now because there's a real desire from corporations as they put out their carbon reduction goals for 2040, 2050, you know, to actually now they turn around and say, well, how am I going to actually do this? How am I going to look through my supply chains, look to my head of sustainability and, you know, and carbon, do this? And so there's basically, you know, a lot of investment that's going to happen. And then if they will then purchase whatever materials that would be sustainable or carbon reducing in a longer term fashion, and even at a premium to the existing products that are out there, so what we call a green premium, that can stabilize these transactions. And that's by and large what we're seeing with a lot of this, and where it can get around some of this technology risk that Petya is talking about. And I would say, and you know, Maureen, I don't know what your experience is. I mean, you have tons over the years. You know, just this concept of technology risk. I mean, and how in infrastructure, this is not something you'll go to, you know, 7, 8, 9, you know, 50 managers, and they'll say in infrastructure, we don't do technology risk. If we want to invest in this company, they have to have the first 4 projects done, and they have to be EBITDA positive, and all that kind of stuff. And maybe you can address some of that a little bit more. But you know, that's just, please take it from me.
Yeah. Okay, so a couple of things there, and I had a couple of thoughts while Petya was talking too, and let me pull a few things together. You mentioned power purchase agreements. So I think the important thing for those of you who may not know in the audience is that you can get 20, 30-year agreements, primarily from governments, as to what they're going to pay you for electricity. There are publicly run auctions. These are all very transparent. They're online. I mean, one of the things that we get, of course, is, oh, aren't all emerging markets corrupt? Well, okay, I live very close to New Jersey. Sorry to anybody who does, but like, yes, there's ways of doing business around the world. These are publicly available auctions. You see exactly to the penny who won a PPA. You have that long-term cash flow, which enables you then to run your investment models and know exactly how you're going to build something and have this profitable cash flow stream. My firm is run by a bunch of engineers. I'm one of the few finance people, so it's a bunch of engineers. So they build stuff in complex markets, and they know how to do that. The new technology, and I think the thing that becomes very important, and again, I'm only speaking for emerging markets, we are profitable without government subsidies. Now, what we do have in our markets, though, is the very critical partnership of the world development money. So think of the World Bank, think of the Commonwealth Development Corp, CDC out of London. Think of the world that is trying to channel low-cost loans to emerging markets to improve the quality of life writ large. and power generation is one of those. So what you have is a carrot and a stick approach, and we mentioned government, we mentioned corporate, and the importance of aligning all of these to get it right. And again, I go back to, we are at a glorious moment in time where I think there's going to be so much dynamic happening. We don't invent things in emerging markets. We need them to be invented and tested out here, and then we take them there. But we right now are very excited about the nudge that certainly the Paris Accord and the upcoming COP26, which you're all familiar with, is going to be happening in the first week of November. And these are all regulations that will push and continue to push towards the technologies and the broad implementation that will help the profit-seeking money to go afterwards. So I point to India. Their renewables goal has gone up, I think it's like 440 gigawatts or something by 2030. So you have all these countries now putting 2050, 2030 goals out there. And the amount of wind turbines, the amount of solar panels, the amount of cobalt, lithium that's needed to get there is almost insatiable. And you know, there is a supply-demand problem even with that, but the opportunity set is there. And what we are very strongly looking at is, we do solar and wind, fine, we're there. Two things to let you know. Wind blows harder, sun shines brighter south of the equator. So you put a wind turbine in Germany and you put one in Brazil, it is going to be 3 times more efficient and effective in Brazil. So it's a slam dunk that renewables in certain areas, and that's what we're specializing in, right? You're not going to go put solar in some place that rains a lot. You have to put it in the right place in our markets. But it can be so much more productive. And with that carrot out there of low-cost loans to a government to go ahead and build out their green infrastructure because of that zero-cost input, to work on battery, need 24/7. You know, you can't have a hospital running just when the sun is out or the wind is blowing. So we do use natural gas as a transition fuel, which I think is a very fascinating topic as well coming up to COP. And you have that ability to really do both. So I guess the carrot and the stick thing in our markets is working exceptionally well. And the minute that any of that other technology gets affordable, the opportunity to implement on a broad scale is phenomenal.
That's terrific, and that makes, Peter, you know where I'm going. So that, in terms of some other areas for baseload power generation that are carbon reducing and maybe don't have the regulatory support that wind and solar already have, so things like geothermal, kind of how is that progressing as one topic, and then the second topic I want to bring up with you is some of the other big carbon-emitting sectors like plastics, and then the insatiable, as Maureen said about insatiable demand for certain things, insatiable demand from consumers for sustainable packaged goods, for alternate proteins. So just to tie into some of the themes that even we've heard at the conference. Yesterday was a great panel on alternative proteins, which is really cool. But Peter, what are you seeing?
Yeah, no, and then queuing off the comments that were just made, I think there's sort of 3 driving factors that I believe are going to generate or are generating huge investment opportunities. It's really this decarbonization and then the resource efficiency as well as the resilience of some of these solutions. I think we look for things that tick all those 3 boxes, and I think those are applicable across emerging markets as well as developed markets. And being able to really, look on a global basis, I think helps spot the right solutions, and then also getting them to the right applications. And one of those solutions where I think there's a lot of good lateral thought that's been applied and is being applied currently is geothermal. So it's really taking a lot of the innovation that was seen in the shale industry over the past 10, 15 years and translating that across to a sector which had seen less innovation than maybe perhaps, or certainly less well-known innovation than we've seen in solar or wind. So really taking horizontal drilling and the cost declines in in the oil and gas industry, have basically brought into the money a lot of applications in geothermal that were previously just not economic. So again, that's this, things are entering this interesting window, and if you can get geothermal to work, it is baseload clean power, which is ultimately then obviates or complements either obviates the need for a battery, or it complements solar and wind, which is intermittent, and really gets us to that, the last 20-30% of the grid that has to be decarbonized, that's most challenging. So we believe that is a fascinating area that's complementary to the whole suite of solutions that's out there, and spending a lot of time on that space. And in terms of the other industries around, whether it's plastics or more of the kind of agri-food domain, that's an area we spend a lot of time as well. I'll speak specifically to the plastic space, where there are effectively bioplastics, whether they're bio-based or biodegradable. If we look at the life cycle of those products, there's huge optionality and opportunities that's embedded in some of the attributes there. We can think of an ecosystem where, from a food court, let's say, all the cutlery and the plates and things are made of biodegradable materials, so then things all get directed into the organic stream, and really thinking about the ecosystem, that sort of how do we solve this as a society, really. And that takes a lot of convening power, a lot of different actors that need to come together, and we're proud to play a small part in bringing those together and supporting the companies that are looking to really move the needle.
Yeah, thank you. It's super helpful. And there's these. We're talking a lot about carbon reduction, but it's really about environmental sustainability, and like the E of the ESG, which we've talked quite a bit about at this conference, and we won't even get a chance to talk much about the S and the G, but that's all something that is in part of our investment processes, which is kind of interesting to note. Talking about just this, getting back to the whole geography and the nature of where these investments are, Petya, in terms of your portfolio, where do you look? Will you invest? Is it only in U.S., North America, or is it outside?
So we invest globally, and we don't have any restrictions on how much we need to invest in a certain geography. Naturally, we try to have a balanced portfolio, which, talking about risks, also exposes us to different risks and different opportunity set as well. Historically, the city of New York or New York City retirement systems have not invested in emerging markets on the private side, but with infrastructure, given the opportunity set there, and Maureen very well described that opportunity set, we actually were able to invest in emerging markets in a strategy that is primarily focused on energy transition and renewables. So I'm very happy to share that we are a global investor, and we were able to invest in emerging markets as well.
And I don't know if you personally have an opinion, and Maureen and Pieter, of how we're doing around the globe. Where are the most opportunities? And when I say the most, it's really, there's tons of opportunities everywhere, but how quickly are certain parts of the world, let's say Europe versus Asia versus US, moving along with transition? And that can be many things. It could be the legislative part, the regulatory part. It could be where corporates are located, where manufacturing is. It could just be the consumer sentiment. But what are your thoughts on that? How it's going?
Yeah, it's a very nuanced question, because there are opportunities, but also there are different returns. And in certain geographies, we see the returns being pushed down. As we think about Europe and the US, a lot of the areas in straightforward renewables are generating relatively, at least for us, low returns. And then you need to go up to the risk spectrum with taking more either construction risk and or development risk to be able to reach some of the benchmark targets. And then when you look globally, more towards emerging markets, markets in Asia or Latin America, even Africa, there is much more growth. And to Maureen's point, just radiation is better. I was smiling when you, Maureen, mentioned Germany because 15, 20 years ago, in a prior life, on the direct side of things, we worked on a deal with Germany, a portfolio of German wind farms, and guess what? There wasn't wind to blow, so the deal didn't go that well. But yeah, we see also the contracting structure being different in different geographies, and again, in some of the emerging markets, much longer-term contracts with creditworthy counterparties.
Now I don't have to ask you about what your worst trade it was, but we cover that. But because Petya probably can't say, but I can, just in terms of the return she's talking about. So let's say, large-scale wind and solar, in North America, talking about 6-7% type of returns. Obviously de-risked in many ways, but that's and for many plans, many investors, that's a great bogey. That's terrific. But when we kind of look now, as Petya was saying, and Maureen, just in terms of emerging markets in different places, different risks, but increasing returns, and this is all kind of absent, technology risk. So, Maureen, what are your thoughts?
So, you can still get good returns in the emerging markets, but there's so much money sloshing around now. We've got some very dumb money that is coming into our markets, which is always dangerous for two reasons. These are complex markets within which to operate. So we've been doing it, as I said, with a 70-year heritage, with a 20-year real track record of doing it. When this silly money comes in, it distorts everything on the ground, the pricing, and the silly money inevitably leaves because they don't do it quite right. So that's a danger that we are seeing right now in operating assets. And we do have two lines of business. We do have operating assets, whereas I think if you were to buy an operating solar or wind farm here, you mentioned 6, 7. I think on the pure operation, it's even down to like a cap rate of like 3 to 4. In our markets, you can still get 8 to 10% of a dividend flow on operating. But how we really go ahead and make the money in the 20+ range for our clients is to take that development risk. But like I said, it's not totally greenfield because we've won the PPA before we even do shovel and ground. And then we're a bunch of engineers, so we know how to build stuff. But that still is the type of return profile you should be expecting if you take development risk. The other thing that I'll mention, because I'm sure all of you are wondering, like, what about FX risk? What about corruption? What about a coup? What about all these things that happen? Because that's what the newspaper tells you happens in emerging markets. The World Bank and numerous others has an insurance policy that you can almost insure, and we do. We are the largest purchaser of these insurance policies, in fact, where you can assure and insure against multiple types of risk. FX is still one that's out there, and that, yes, is something to consider. You get a blend of dollar PPAs, local currency PPAs. There's a way to help with the portfolio construction. Other risks can be mitigated, and that's that partnership with the DFIs that matters so much. One more thing I just want to say, because we're not...
And define DFI for...
Oh, sorry, Development Finance Institution. As I said, it's the World Banks, it's the International Finance Corporation, it's USAID, and every country has these. It would be remiss if I didn't mention the S&G very briefly. It is very possible to go in the ground in these emerging markets and leave behind not just a great wind farm and good returns for our clients, but a very positive impact on the community. And if you go in with that lens of leaving something positive behind on day one, the added cost to implement is nil. So we build schools, we build libraries, we build water filtration plants, so we defluoridate the water so the kids don't have bowed bones. And that from day one is part of every project that we do. And that's that element that I think also has applicability as we go to other developing markets and developed markets. And I think this responsibility and this idea that money can do both is an unstoppable wave that people now really understand. And it's that having that lens on day one and building it into your model on day one.
Well, I love that. Well, like where a lot of, I think, our best known climate advocates like Bill Gates started, it was really on a health journey, which thinking about how these things tie together and thinking about the technologies, about the feedstocks we're using to create sustainable products around the world. A lot of them are bio-based. There's a huge interconnection, which that's a whole other topic to discuss. Pieter, any thoughts from your perspective just on geographies, like who's getting it right, who's not, like what's happening?
I mean, the thing that came to mind just listening to Maureen's answer was also just the fact that one of the investments that taught me the most was an African gas-to-power investment. This is 8 years ago now, where just it shows all the good and the bad of the sort of the very centralized power grid and the chain of payments that you rely on and the guarantees that you need to be able to get comfort as an underwriter, and really sort of taking that and then looking at the renewable space and how can we create a decentralized grid that doesn't have some of these dependencies and therefore can also hopefully scale quicker and grow quicker, I think is hugely applicable in emerging markets as well as here as we look at resiliency of our own grid and some of the wildfires and other things that are causing us to rethink a lot of that. So yeah, these are all just changes and opportunities which we're trying to do our best to capture and treat as tailwinds.
So just we only have about 4.5 minutes left, and I want to make sure if any questions, which I can't see any of you, but if there's any questions, you'd like throw something at me. But maybe kind of last ideas about just like cutting edge stuff, and again, many more topics we that we can have about hot money, silly money, like SPACs, I mean, all kinds of stuff, money chasing tech. But in like the next, I guess what's happened to the panel, what's happening now, and maybe maybe what will happen in 5 years from now, like what are your thoughts on some of these technologies that probably we hear about, like nuclear and fusion and hydrogen, like just your thoughts, and maybe like how you and your institutions are thinking about things like this that could be disruptive to some of the things that we're investing in today, or maybe not.
Yeah, I could start. I mean, it's sort of I think disruptive, yes, but also just complementary. The energy sector is so big that just one breakthrough isn't sort of going to obviate all the rest right away. So we're certainly watching the fusion space and making early bets, making sure we're sort of on top of those developments. So that's an area which I think we'll be talking about 5-10 years from now and continue to get closer to making that a commercial reality.
I would say don't yet count out natural gas. It's the transition to the wow stuff in 10 years. And there are some places in the world that can't do renewables. I mean, I often find I'm in a geography class where I remind people, look at a map. Here's Bangladesh. It is swamps and islands. There's 163 million people there. You cannot put solar panels up and generate enough power. So we have to use natural gas. So what we're going to do with this current vintage product that I think is exciting is we will integrate hydrogen into some of the natural gas pipelines as possible, which will help in the reduction of the overall emissions. I think our thinking in the 5-10 year plus is we do believe someday this concept of the peaker power or the baseline, whatever you want to call it, when it's not renewable. We're very excited about battery. Now, that could be traditional batteries as we're looking at them now, lithium ion, or it could be hydrogen as a storage as well. Hydrogen is not what's going to be used in our cars. We might use it in cement manufacturing and steel manufacturing. But hydrogen as a battery, I think, has great possibilities. We're less excited about fusion. It's a little too far out for us to even envision. And nuclear will remain what it is, right? And so good decommissioning of nuclear plants. It's the most clean energy out there.
Hydrogen is interesting. I was reflecting as we were talking about these technologies, and hydrogen was so much more marginal just 2 years ago, not talked about in the infrastructure space anyway. And all of a sudden, now everything is about hydrogen. So I think what's fascinating is how quickly some of these technologies become more downstream, to your point about more private equity, technology, growth equity, and then going downstream to infrastructure. So that's what we are monitoring, and I think there are going to be some investable opportunities relatively soon. Definitely more quickly than I expected.
Cost is definitely coming down. I mean, we monitor the cost as well, and you guys might not know, but solar, wind, the cost is down like 90% from 10 years ago. Hydrogen is on that same trajectory, and it will flip at some point.
Yeah, we're seeing. I mean, and we're a growth equity. We tend to get involved earlier than than this traditional infrastructure. And as an adjacency to natural gas and the infrastructure we have in the United States, it is a tremendous growth area. It's a tremendous focus. So when I think about my contribution of this geographic discussion, is that will be one that I think will get pushed, and there will be initiative from a regulatory perspective, and just really what's in people's current portfolios. So we have 14 seconds left. Any questions of when I can see you? Hi.
Just the presence of more activists in this space, is that putting a little bit of pressure on sort of time duration and sort of project expectations here?
Yeah. I'll take that one real
Sure.
quickly.
Yeah.
Yeah, activism in the space. Look, we love activists in general. They're good and they're bad, right? They are, no question, a large part of this impetus that we will not see going back on in terms of, you name it, carbon, D&I, all of this stuff. The activists, and I would say social media, very, very important to keep the thing going. Where I would say sometimes activists run afoul is, let's go to natural gas, okay? It is an important. We cannot just go renewable, no matter how much we want to. There is simply a path to get there. And so sometimes I find that activists, in their zeal, can derail a conversation and prevent, at the end of the day, this is about people and the planet. And how do we go to people in India and say you cannot have air conditioning, which will improve your quality and your health of life, because we don't think you should have it? So that's, I think, where I think, activists good and activists can be bad, but a critical element to the conversation.
Well, with that, thank you very much for your attention, and looking forward to speaking again about this.
Thank you.